Hi guys, and welcome back to Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. We're going to go over this video right now. This is from Fox News, and this is about private equity. Let's go ahead and break it down, and I'll give you my best answers. And I'll pause it here and there, but let's go ahead and look at it.
The private equity industry has long claimed it does not pose systemic risk to the U.S. economy, but credit ratings agency Moody's says not so fast. Things could be changing. According to a new report, Moody's now expects a race to the bottom between banks and private credit funds financing what they call risky leverage buyouts. Banks are starting to up their lending appetite for those kinds of deals, while also facing competition from the $1.5 trillion private credit industry. Moody's thinks that kind of makes a perfect storm of events that will cause pricing as well as terms and credit quality to erode and fuel risk. We know what risk did in 2007 and 2008, right? The financial crisis. Well, PE firms using private credit is not new, though. Private equity king Thoma Bravo has overseen more than 450 acquisitions, and earlier this year used private lenders to fund its $8 billion purchase of Coupa software. Thoma Bravo's founder and managing partner Orlando Bravo is here in a Fox Business exclusive. What do you think of this Moody's fear, this warning flag?
Liz, thanks for having me. It's nice to be here in your studio.
Great to have you. Great to have you.
So look, I just want to establish this at the onset. When a deal is financed, it's never over-levered. People are not going to put in all their capital. The owner, the private equity firm, management usually invests greatly in these deals, knowing that they have an over-leveraged situation. The lenders, they're very smart, whether they're private credit or the syndicated market. They're not going to just jump in with all their capital that they're responsible for to over-lever a company.
So he is actually correct in a way. You know, these private equity firms manage, and there's plenty. There's not just like the top 7 that I named, but there's so many private equity firms that manage, hundreds of billions of dollars, and if not trillions. So yeah, they won't be over-leveraged on the one deal you're looking at, but there is an absolute domino effect. These guys keep talking about systemic risk to the market itself and or to the whole system. And the problem that you're going to have here with private equity, as this man licks his lips, is that they're going to be salesmen. They're going to sell you the idea that they're great and they can't go under. But you saw what happened with Lehman Brothers, and you saw what happened with Bear Stearns. There's nothing different going on here. If GameStop, give you the example, was not a risk to the market, why halt it? Why halt the whole damn thing? Why hold it hostage for 13 days? Because certain firms were leveraged. And you might just be the outliers, right? Some guys are not, some guys are. But I'm going to tell you something different about what's happening today versus then, and or any other time in the history of private equity. The heyday of private equity is the 1980s, all the way through 90s, 2000s, and now. So 40 years of what everyone's been able to live with, which would be low interest rates. Initially, they were 20%, 15%, 82, 83, 80, 81, that time frame. But as they got past that window, it is now basically free to borrow money. And yeah, there's been some headwinds, but there's been more tailwinds than anything. But right now, you're sitting at 7.5, and people are telling you can't borrow money. The exposure from private equity firms is the issue. The exposure from any company is the issue on debt. And all it takes is one bad PR campaign, one margin to change, one supply chain issue to sway in the wrong direction, and then that's what you're going to have. So the companies that are not exposed to what the problems might be for the economy moving forward, these guys, they can say this in a box. They can say, you know what? We're not at risk. We're not scared. But you really are, in a sense, because what happens when the rates don't come back down below 4%? And they just stay at 6 and 5 for years to come? It's going to be harder to borrow that capital. You've been borrowing money for so long well, I'll let you explain it in your own words here.
Now, a company can be over-levered when it misses its numbers.
Yes,
now, I could see in the current environment where things have slowed down, the cost of capital is higher, interest rates are higher, the base rate is higher. I could see some situations where companies may have some trouble meeting their payments. Now, the key reason why there is no systemic risk in private equity is very simple. Systemic means a whole system.
Yeah, takes down the whole system because it falls like a domino.
And private equity firms it's such a big market, and private equity firms are so different from one another.
Didn't I hear this though during the housing, right before the housing bubble burst? Everybody said, oh, it can't trigger a terrible recession if the market were to turn because it takes too long to unwind or sell a home. And then sure enough, what did we see? We saw disaster. But you're saying in essence that under perfect situation and under perfect atmosphere, things will be fine. And even if there were problematic events, whether they be global, economic, whatever, still these companies should be able to make their payments?
Now, before he answers this question, you guys have to remember what happens in that window of 2008, 2009. It's the forever printer. We have the golden goose. We literally can print as much money as we want, being the American government. And with the leverage and the lobbyists that exist from private equity onto Wall Street, and onto DC and that swamp, this is why they're not scared. This is why they're just fearless. Because no matter what they do, whether they shut down the stock market and or they print more money, they're okay. The greed is there. How big of a deficit is America going to have to go through before you guys actually figure out that private equity were the villains of it all? And people say things like last night, if you saw this video, that they paid someone to make about me, which is crazy. I can't even imagine this idea that you want to bash what we're saying here as far as private equity is a term. It's not a term, it's an investment. It's an investment fund itself. But in addition to that, there's a new term. There's a new category that didn't exist back in the 80s that exists now. And that's distressed debt and or credit, that they're loaning out money. There are funds specifically for this and for this reason, because money's free. And when capital's free, guess what happens? You can manipulate it, and the risk is minimal. The downside is minimal. That's what has happened over the last 15 years. So right now, you are prime for an explosion. You are prime for this bubble to burst, because you're looking at 40 years of risk, of leverage, and you're going to tell me it's not an issue? You're going to sit here and say that it's not systemic? That's fine. Then how about the one hedge fund that just goes under? How about the two hedge funds that just go under? 3, 4, 5, 6, 7. You tell me how many are intertwined, and I'll tell you, connect the dots. But I'll let you answer these questions.
Now, I cannot predict a recession.
Yeah.
And nobody can predict a recession. People love to predict it or not. Is it going to be a slow, soft landing or not? What we do as owners of companies, and an example is early 2022, when we saw a booking slowdown across our portfolio. What we do is we assume that there's going to be a deep recession. We're overly conservative rather than overly optimistic. So the way we run our companies is we go back and we take out more cost so that we ensure our same level of profitability in a lower business environment. That way, if there's a deep recession, you're prepared for it and you're not surprised. And if there isn't, you can invest. What I am saying about the systemic point is systemic means a whole system. Mm-hmm. And private equity as a whole cannot be put into a whole system, because there's some firms that focus on many different industries. Firms use very different ways of creating value. So it's not all the same.
And doing their due diligence, which is what you guys are known for over at Thoma Bravo. Let's talk about where you see opportunity right now. What looks good and what is valued most deliciously at the moment, where you are ready to take bites?
It's an incredible opportunity for business owners, and I call private equity business owners. And let me tell you why. As an owner of a business right now, this is an unbelievable time to build a business. The financial markets are in disarray, interest rates are going up, things are slowing down. It's a very difficult macro. But what that means as a business owner is you can really focus on what matters. You can build better processes, better leadership, and you end up, after doing all that detailed work, with a much better business 3 years from now than you inherited. Now,
so what they're trying to tell you, what he's trying to tell you, is strike fear into you as a business owner. You see, individuals develop businesses. They do. And whether they do it with loyalty and with great customer service over time frame, and it just doesn't have to be customer service, like retail centric. It can be anything that you develop. And you might have some employees that are grandfathered in, and you might be overpaying them just for their loyalty and the fact that you're running this great business, right? Business model's awesome. The product's something they need, and your profits are there. What these guys do, they come in and they tell you, well, guess what? We're going to get you paid for your business. No more 9 to 5. No more working every day. No vacations. We're going to go ahead and pay you. We're going to buy that company from you. We're going to give you the money that you deserve. And they're going to come back and they're going to take all the profits. They're going to cut everything out of it. They're going to gut it dry. And here's what they're going to do. They're then going to sell it to another private equity firm after they get the profits from it. Now, this is all fine and dandy in the world of private, right? But when you're in the public sector, let's say you're a publicly traded company, that's when the shareholders need to be aware of what individuals like this are saying. He's saying the markets are in disarray, that you can loan out money right now or go grab it, but how expensive is it? The cost of capital is more than it's ever been. So why would I be expanding now? Why would I be growing now? Why would I be acquiring things now and merging and acquisition? I wouldn't be. Mergers and acquisitions should not even be on the table right now. Not for a company that's trying to thrive or survive. But this is the problem I have with private equity. They see the blood in the water and they attack. They know what they're in. But to say that they're not over leveraged and or that the exposure is minimal, that's a lie. Because these interest rates clearly tell you a different story. This economy clearly tells you a different story. When he tells you in the same breath that he just said it's not a problem, he also said, well, in 2022, we saw our bookings less. That means less companies are IPOing, right? 40 companies, 30 companies. And when it was 700 just 2 years ago, yeah, there's a problem there. People are evaluating the cost of capital, the cost of actual manpower, and they say, you know, I can't go public or I can't expand my business. I can't take on more right now. It's too risky. Their risk assessment is correct. But let's see what you have to say about any of this.
Now, in the market, what's happened in software, and that's what we focus on, software companies, we try to buy the market leader, and what we try to do is buy the best innovator that we can then turn into the best business. And those things are not necessarily the same. What's happened in software over the last 25 years, and will continue to happen, is these great innovators, on average, lose money. They have market leadership, they have revenue growth, they have billions of dollars in revenues, like the deals we've done recently.
But they can't get that profit together.
But they're not profitable. So groups like ours partner with management, and therefore we create a system where you can also provide great profits for the shareholders.
And, you know, you're a
So let's talk about that. Now I want to talk about GameStop specifically with what he just said, because I saw in the Discord last night, guys, and this is a quality video for anyone who's been a part of this channel for the last 2.5 years. I want you guys to see what they were saying last night in the Discord. They were trying to say how Best Buy and the amount of money they make versus the amount of money it costs, you know, to run its business, and then what percentage of actual revenue is profit, right? So they would say, well, look at this. How much is this? How much is that? And I want to give you this example, okay, of everything you just said. If GameStop sells $5 billion worth of product, you know, that's going to be great. But how much would you want to net a profit? Well, $250 million for the year, right? That would be 5%. So you say, okay, they can net 5% profit at $250 million. And everyone's like, wow, is that a good number? It's an amazing number, considering the expenses. You know, GameStop not only paid all the debt off. That wasn't the issue. What they did last year, put an incentive program for leadership, for retention, paying the store directors with RSUs. They took money out of the coffers to basically reassure themselves that the retention of those guys, the leaders of the store, they now have the incentive to do more because they want that share price to go up. So plenty of people took pay for shares, and they're sitting on them, waiting for them to produce a profit. But this company paid itself. It actually invested in itself. Now, when you're the venture capitalist fund, like Ryan Cohen is, RC Ventures, he's not putting money into GameStop with the idea that he's going to lose it. He's putting in tens of millions of dollars each year with the idea that he's going to increase a return. Now, these guys' returns, if you ever got them 4 and 5% back, oh, hell no. They would look at you and they'd be like, I don't want 4 and 5%. They've got pension funds that need 7, 8, and 9, and 10. This is why they have large investors, billion-dollar funds that go in. They have to return 10%, 20% in some, you know, unspoken promises. But I'd rather under-promise and over-deliver type style, like Ryan's doing, like I've done with my live streams and my videos all week, as you guys stated. But what you have to understand, guys, what I'm trying to tell you is this. If GameStop's selling $5 billion and they're producing 5% in value as far as the actual revenue itself, net gross profits, and I don't mean net gross the same, you can't say that in the same sentence. Net profits itself, okay? Unedited, no edits, no cuts. You guys know this. But if they're bringing in that much and the market cap's $4.5 billion, what's the best buy on the market? What's the best buy on the market? You look at PE ratios and you find it out. When it's $250 million, you times that by 20. Well, what are you going to do? What are you going to do? Because 10 puts you at what? 2.5 billion. 20 puts you at 5 billion. And you go, oh, it's a $5 billion company. Is that it? Is that it? You tell me what the amount of profit they bring in and what they are. People look at things in a little window and they say, you know what? Nah, 20 times profit earnings? No way. So then what are we going to do? We're just going to look at every company out there and say they're all overvalued. Every single one in the world? Okay. We'll have that conversation in a minute. Let me finish off this video.
Private equity guy, you buy businesses outright. Important to note, though, for some of our retail investors, they want to buy a piece of a business in the form of a stock. Our stock screening shows, and we just put up some of them, maybe we can put them up again. And what we did was, working with your model, looked at publicly traded software companies that have a PE of 30 or lower, but that are profitable. So Cognizant, Gartner, Verisign, EPAM, Gen Digital, and we're going to put all of these up on our Facebook page. You don't talk about individual names, but
think about this. Profitable companies with a market cap of under $2 billion. This is what everybody should be buying, right? That's what they're trying to tell you. And guess what's not on this list anywhere? Well, it's not GameStop just yet, but it will be.
what about the AI picture at the moment?
Oh, well, it's unbelievable for enterprise software.
It's unbelievable.
Think about it. AI has just increased, and in many cases potentially increased, the value of enterprise software solutions for their customers. Most enterprise software, you own a system of record for a company. You own data. You own a workflow process that is very important for that enterprise. Whether you're serving a huge corporation or a middle market company, now you can embed generative AI into your systems so that senior executives at your client or at your company can interact with those systems in a more human way.
So embedded. You don't have to have a pure play AI company. You just buy the companies that already have it embedded. Orlando, please come back.
Orlando, please don't come back. Yeah, so it's not an issue. All right, private equity is going to be here and they're going to be okay. So if they are, and people are asking the questions, and last night, this is a combo video. I could do this in two different ones, but I'll put it all together. Last night, we had an individual come into the Discord and tell us why Best Buy was the buy of the century compared to what GameStop is doing and try to have all the connections. But if you look at the cash burn for Best Buy, I believe, maybe somebody can correct me, but they've lost over $2 billion in cash over the last 3 years. The cost to do business is infinite when you think about the environment you're stuck in. The fact that GameStop still has $1.2 billion after everything, the fact that I'm still here making videos after everything, people are going to attack the idea of GameStop. People are going to attack the idea of this channel and or to give you that information. Come on down, take a bite, honestly. And to the next guy that I got to debate over the fact that GameStop's actually profitable and or a great buy, don't worry, I'm ready for it. GameStop, can't stop, won't stop. GameStop. I'll see you around, millionaires.